This week's Market Monitor is finding opportunity in the U.S. and is recommending ETFs that he says pay a good income. The last time he was on in January, he picked the iShares Technology ETF, which is up 7%. The Vanguard Total World Stock Index less the U.S., which is down 15%, and the Vanguard Emerging Market Index, which is lower by 10%. Joining us once again is John Merrill, Chief Investment Officer of Tanglewood Total Wealth Management. Welcome back. Nice to see you again. Let me start, before we get to the new picks that you have, I'd like to address the Vanguard Total World Stock Index, which is down 15%, and the Vanguard Emerging Market Index, which is lower by 10%. Do you still hold those? Did you add to the positions on the decline? Where do you stand?
First, I don't think the VEU is down 15% from when I was on. It's probably down closer to 5%, from when I was on last time. But to answer your question directly, we have reduced our international holdings by about 20%, but I still do own a big position in the VEU. We have totally sold out of the emerging markets. And that comes back to the one theme that I brought up in talking with your producer, which is domestic over international. The introduction of the U.S. corporate tax reform just totally upended the synchronized global growth that we had going into this year that we had assumed would continue into 2018. U.S. corporations are very fortunate. They have had a cash windfall from not only the lower corporate rates, but also bringing money back from offshore. And they can use this money for new investment, for expansion, buybacks, dividends. And this is an advantage that foreign competitors simply don't have. And that's kind of overwhelmed the markets this year.
Forgive me, though, John. You didn't see that the tax reform package would give American companies that kind of advantage? I mean, that was the whole idea behind those tax cuts.
Well, that's a good point, Bill. It was passed December 22nd. We knew it would have an impact on earnings. We knew domestic stocks would do well. So right as we entered the year, we did lower to neutral our international weightings, which actually at the end of last year had been overweight because of the valuation discrepancy. But I guess, yes, we missed the magnitude of the change and how it would ripple through the foreign markets. We knew it would be an advantage to domestic stocks. We didn't really quite realize, you're right, until maybe February and March, just how this was going to actually take away from some of the foreign competitors.
Well, let's take a look at what you're recommending this time around for us, John. First up is the iShares 1 to 3 year Treasury bond. The symbol is SHY. Ultra safe income, you say?
Exactly. A couple of years ago, if you would have bought a 1 or 2 or 3 year Treasury bond, you'd have got exactly almost zero. The Fed has been raising short-term rates, and now you can get literally almost 2.5% on a 2-year Treasury. That's only about 35 basis points less than what you get on a 10-year Treasury for a heck of a lot less risk. So we look at the short-term part of the Treasury market as the sweet spot for risk and reward.
The other two, and just in the interest of time, I'll mention them both here. You're looking at a master limited partnership from J.P. Morgan and the REIT index from Vanguard. Clearly, you're looking for income down the road as the Fed's raising rates. But you're convinced that rates aren't going to go up that much down the road. Why?
Well, it's just like we've experienced the last 2 years. The Fed's been raising short-term rates, but intermediate and longer-term rates have been very sluggish and have not moved up in lockstep with the short-term rates. And we believe that's because there's a lot of big factors that are affecting inflation and interest rates, forces like aging demographics, like the transparency brought on by the internet, things like that. Right now we have more aggregate debt in the world than we've ever had before. All that debt has to be serviced. That puts enormous pressure on rates.
On that note, John, thank you so much for joining us once again.
Absolutely. Glad to be here.
Read more about John's picks, you can head to our website, nbr.com.